And welcome to the latest episode of Ask ProVisor. My name is James Mercado. I'm the president of ProVisor. I have with me Ritchie Baumann, one of the smartest, best loan officers in the country. He's brilliant. So we're going to get inside the mind of Ritchie today. And those of you who know Ritchie know that he is very strong in technical knowledge, understands this business very well. So I'm honored to have him on the show today and to talk about a lot of tough stuff. Welcome, Ritchie.
Thanks, James.
You're welcome. Not trying to embarrass him, but I am.
You did.
Yeah. And today's his wedding anniversary, so happy anniversary.
Oh, thank you.
Yeah, you're welcome. So a lot of people say, why are you guys doing this Ask ProVisor thing? Well, I've been doing this business over 25 years, and it is a difficult and challenging business. So our heart is to be able to lead with a giving hand and to help all of you real estate agents when you're out in the field or talking to a borrower or whatever. So you're educated and empowered to make great decisions, to help your borrower, to bring value for yourself. So they say, so your client's like, oh my gosh, this is amazing. I didn't understand that, or I didn't know that. So we're just trying to help make it a better standard for everybody. So one of the things is, Richie and I were talking, like, why, specifically this segment, why are we doing this segment? One of the things that people,
What's the segment about?
yeah, why don't you tell that, Richie?
We are live.
That's right. Sorry.
This segment is what we want to talk about is a mortgage interest rate. Because two reasons we decided this why. One is you as a real estate agent are getting asked by buyers and sellers about what do you think an interest rate is? Where do you think they're headed? Just like we get asked, but it's kind of been top of the mind with the media because of the national media talked a lot about the last Federal Reserve and what they did. So we're going to talk about how that correlates. And the second part is, and I was telling James, I feel bad for the realtor situation. Lenders email you all rates to get your business, to get your attention. And I actually just had a realtor that I know told the buyer in the offer they were writing that was going to be their rate that they got emailed generically that day, and it wasn't their scenario. And so we're going to talk about that so you understand those emails when you get it, but that's our heart of why I thought we should do this today.
Yeah, so the fine print's a real deal. So we get calls also where people get something in the mail from, ABC lender out of, Los Angeles, California. And we say, well, flip it over, look at the bottom, get your microscope out or a magnifying glass and read what it says. Oh, you mean I only have to pay $32,000 in closing costs, points, and fees to get 4%? Yeah, that's not a good deal. Oh, okay, thank you.
Just got that email this morning from someone wanting to refinance. Yeah. She said, my rate's too high. And she told me what she was getting. And I go, you better read the fine print.
Yeah. So it's the same when lenders email you as real estate agents, and they send you their rate sheet or they send you this information. You got to remember they're usually doing something with like 40% down, 800 credit score, minimum loan amount of X, 300,000 or something. And a lot of clients might not fit into that bucket. So it's always important that they read the fine print.
Yeah, because if you're advertising, I am going to put my best foot forward about who we are. Yeah. To get a customer's attention.
Fair.
And get them to just call me.
Yeah.
Because that's the only goal. So why wouldn't, as lenders, just send out the best rate possible for the perfect scenario that's happening? Right.
And then we back into, what's your situation? Oh, I had a bankruptcy, or, I had a collection, or my score's a 680, not an 805, And those are different situations then.
We're going to break that down a little bit.
Yeah, we're going to get into today. So the reason that we led into this whole thing about interest rates is since COVID, when rates were in the twos, the Federal Reserve got involved, and when prime rate was zero, they kept raising. Remember, they kept raising a little bit more. So finally, they dropped it a little bit, and everybody's like, "Oh my gosh, the news jumped all over this. Rates have dropped. But the reality is, today we're going to kind of break down what does it mean when the Federal Reserve gets involved in pricing, and how does it translate into an interest rate, right? So one of the things that a lot of people don't understand is it's a term called GSE. It's a government-sponsored enterprise. And the GSE is Fannie Mae and Freddie Mac. They're not owned by the government, but the government sponsors them. So there's a little bit of influence, we would say. They came out with what we call loan level pricing adjustments. And Ritchie, speak to that a little bit.
So Fannie Mae, Freddie Mac, they've got this, who knows how big this database is. This is how I understand it. This database of mortgages over tens of 50 years, I don't know, as long as they've been around, right? They've got this database and they're able to track exactly what scenarios performed well with mortgage payments and what scenarios performed poorly with mortgage payments. And
God bless the actuaries, right?
yes. And it's kind of like life insurance actuaries. What they're doing is, and so they look at this predictive, and what they do to an interest rate, we call a loan level pricing adjustment. They will make an adjustment based on the credit score. They will make an adjustment based on the type of house. They will make an adjustment based on the historical data for that scenario. And nobody ever talks about that, because we get to see them, but I don't pay a whole lot of attention to them because I can't affect them.
Right.
The
government a few years ago said, wait a second here. We want everybody to be able to buy a house. So we want the rate to be the same for everybody, regardless of credit score and all this kind of stuff. So they came up with this great idea. It says, okay, we'll get you the same rate, but the risk isn't the same. And that's what they're saying. Right. There's more risk for the guy with a 650 borrower than an 800 borrower. So even though we don't want to discriminate because we want the 650 borrower to get the same rate, we're going to say there's a loan level, there's an adjustment to this. So the plan was that the customer that had the lower score was supposed to pay points. Right. They were supposed to pay those pricing adjustments to get the same rate. Well, people usually don't have the cash to do that. Right. They're just trying to scrap it. So now what happens is it gets built right back into the price and the whole thing starts all over again. So,
but do you remember, was it last year that it hit national news where they decided they wanted to help the borrower who had tougher credit score, and the national news made it sound like they were penalizing the better credit scores, right. And so that the people with the better scores were helping the people with the lower scores, and that's not really how it worked out.
Correct. That's not how it works out. But they get a little bit of misinformation or a little bit of information, then they build a whole news story around it. And we have a mess.
Because what I saw that they did when I look at how we look at interest rates is those lower scores, they just had less loan level pricing adjustment.
Right.
It didn't really hurt the people with good scores. Right. They just tried to help the people with the lower scores get into houses.
Correct. So let's break down what that looks like. So we have the borrower.
Yes.
John Doe and Jane Doe, or John and Jane, or Jane, John or Jane, whatever. So we look at credit score, right?
Credit.
How big of a deal is the credit score, honestly?
I think it's the one that most people realize affects their interest rate. When I talk to borrowers, they pretty much understand that the lower their credit score, the higher their interest rate can be. Do I think, in my experience, is it a huge change? No. I mean, you take someone with an 800 credit score and you take someone with a 620 credit score, that might be a half a point, 3/4 of a point difference. To you and me, that's not a big deal. Maybe to the consumer or someone else it is.
Yeah.
But it's not like the difference is 6.5% and 12% between those two scores.
It's not that big of a gap.
No, it's not a huge gap. And, if you're going to get down to, like, the lending rules allow it to go down to a 500 credit score.
Yeah.
Okay. So those people are going to have a higher interest rate, but they're going to pay these things that we probably talk about discount points.
Yeah.
Because it's more risk.
Bottom line is a 500 credit score is going to have more risk than an 800 credit score. Yeah. Statistically, that has been proven.
Right.
So let me ask you this question, Ritchie. This happens every day. They're out with their real estate agent and they're on Credit Karma and they go, oh, look, my credit score is a 780. And then they call their loan officer and the loan officer tells the real estate agent, no, their score is a 642.
Yep.
Like, no, it's not. It's a 780. They showed it to me. Why is that?
So there's two scoring companies in the United States, FICO and Vantage Scoring.
Okay.
The mortgage world uses FICO. The auto world, I think, uses FICO. A lot of the credit cards uses FICO, but Credit Karma uses Vantage Scoring.
Okay.
And here's how, by analogy, all the difference is. You got a Chevy and you got a Toyota.
Okay.
They both get you from point A to point B. That's FICO and Vantage Scoring.
Okay.
But inside those car makers, there's different models.
Okay.
So each one of those have different, so FICO and Vantage Scoring each have their own math formulas. So now the performance of a Toyota Camry is different than a Chevy Silverado. If you punch the gas, different gas mileage. Okay. And that's really what the difference is. It's not false information like people think. It's just a different math formula.
Okay, so when they give you that score, you got to say that's a different scoring model, we need to look at the FICO model.
Yeah.
That's what lenders
Yeah,
use.
but it's a good idea. I mean, it's a
Yeah.
general idea for it.
Okay. So then in the world of lending, so you got the credit score.
Yep.
That helps make up your interest rate, but loan type. So I've noticed, real estate agents have asked questions like, why is the FHA interest rate this when the conventional rate is that, or the VA is, why are they different?
So to my understanding, one is the loan level pricing adjustments.
Mhm.
Even conventional in our world is Fannie Mae and Freddie Mac, but they don't have the same loan level pricing adjustments all the time because they have different databases of information.
Sure.
So that can be the difference. You may speak better to this. Tell me if I got this wrong, but behind the scenes, there's investors in mortgage-backed securities.
Correct.
And sometimes we go through a period where the appetite for those investors, they like FHA more than they like Fannie Mae.
Correct.
And that can cause the FHA to look better. But I mean, wasn't there a time like those investors really didn't want FHA at all?
Yeah. And when we're going to talk about mortgage-backed securities, and we do that, we'll come back to that question because I'm going to dig into that a little bit.
But that's kind of what the loan type is. A lot of people think that the VA is a great interest rate because we got to serve our veterans well. And they are great interest rates, but it doesn't mean that one is always the best either.
Correct.
But so what I want you to know out of this is every loan type, just the loan type change could change the interest rate for the exact same scenario for the borrower.
Perfect. Hey, we're live right now. I'm with Ritchie Baumann, one of the top loan officers in the country. He is extremely bright when it comes to the technical components of mortgage lending. My name is James Mercado. If you have any questions right now, just feel free. We take live questions as well. Just email them to james@provisor.com, and we'll be more than glad to address any questions that you have while we're talking about this. We're talking about what makes up an interest rate today. And it's actually very complicated. It's not that's a simple answer. And it has very little to do with the Federal Reserve, to be honest with you. We're going to break that down a little bit. So, Ritchie, I had a transaction, a customer called me who was confused. Okay. They were talking to a loan officer at another company, and somehow their real estate agent said, call Mr. Mercado over at ProVisor. He'll give you free information. So they called me up and says, I'm confused. All right. I was going to put 18% down.
Yep.
And my interest rate was, I'm going to make them up, everybody. My interest rate was 5.8.
Yep.
And then my mom gave me some money, documented, everything's trackable, it's legit. And now I want to put 25% down, and my interest rate went up. Why is that?
Think about if you're
It's a higher down payment.
right.
I would think it'd be better risk for the lender, but I went from 18% down to 25% down.
If I had to answer that generically, the rate should have got better. Okay. So down payment is a factor because pretend we're the bank, right? I would rather.
I'm sorry, it wasn't. It was 20% down.
20%.
Yeah, I went from 18 to 20 because they were trying to avoid.
Okay,
PMI.
now I know what you're asking me as well.
Yes, they were trying to avoid PMI.
So let's
Sorry
go.
about that.
I'm going to cover the down.
This is live, everybody.
I'm going to cover the down payment generically, and then I'm going to answer why that particular change.
Okay.
The bigger the down payment, usually the better the interest rate because the borrower is taking on more risk by creating equity in a failed mortgage, and the lender's taking on less risk because there's more equity in it. So they usually reward people the bigger the down payment happens. The quirk that can be happening, what James was asking me about in some scenarios is you're probably all pretty familiar that 20% down payment on a conventional loan, if it's less than that, you pay private mortgage insurance or PMI. That is an insurance policy, protects the lender from foreclosure in the sense of it pays the lender's expenses in a foreclosure process. But when you tick over 20%, now the mortgage insurance is gone. Well, a mortgage lender, which would they rather have? A loan with mortgage insurance or a loan without mortgage insurance? So I have found at times when a person goes to 20%, the rate goes up because the mortgage insurance disappears.
So there's a little bit more risk from an 18% down payment to a 20% down payment for the lender.
For the lender.
Okay.
Not every time,
Yeah.
but sometimes. So the inside trick for a loan officer is I take the down payment and I change it to 19.5%, and mortgage insurance can be bought out on a single payment. You don't have to pay monthly. We do that, it's the same money out of the pocket of the borrower, and they get a better interest rate because the mortgage insurance kicked in.
That's why he's so smart, everybody. I bet a lot of people didn't know that. Brilliant. That's a great hack, Ritchie. Thanks for sharing that.
But so then on the down payment, I think we're coming up, it's related to, it's the loan amount. What I've learned over the years and how down payment affects it, Fannie Mae and Freddie Mac, they seem to have this sweet spot that if a loan amount's between 175 and 250,000, that gets the best interest rate. Their data has shown that a person with $100,000 loan amount has a higher risk of foreclosure than the person with the $175,000 loan amount. Seems weird.
Yeah.
But that's what their data shows.
Okay.
Same way if you go above 250.
Yeah.
So now when you go to this down payment again, if somebody's making a down payment that ends their loan amount at 150, maybe it's smarter to make a down payment that ends the loan amount at 175 to get the better interest rate. And then they make a principal payment afterwards to trick the system.
So that
I know we're getting real geeky here, but we're just trying to help you understand, like, this is stuff the borrower can influence.
I think what is important, if I was a real estate agent watching this right now, I'd be like, my loan officer doesn't talk to me about this kind of stuff. And it's one thing to give you a licensed mortgage loan officer, but it's another thing to be a master at your craft. And it's super important that you're in alignment with somebody who's a master of what they're doing. Because this kind of stuff is like, you've got college, you got English 101 and, basic algebra, but we're like in grad school here. We're like getting our PhD type stuff here. So this is really good information. So make sure that when whoever you're trusting your clients with, because you're the gatekeeper, who you're trusting them with, that you're dealing with somebody who's, a PhD in finance, basically.
I mean, I always tell my customers, we talk about an airplane analogy when we're doing a loan. I'm the pilot at the front. They're a passenger on the back. The stewardesses are my operation staff. I said, you really don't care who the pilot is if the plane doesn't crash. Right? But you care who the pilot is when the door blows off like it did that one time.
Right.
You now care who the pilot is. You never care who the lender is when they're an 800 credit score with a 50% down payment, W-2 job, blah, blah, blah.
Easy peasy.
You don't care who the lender is, but you do care when there's a little turbulence.
Yeah.
Or you do care when you want to make sure the best things happen for a borrower in this arena we're talking about.
So back to the topic of interest rates.
Yes.
So let's just talk about the collateral. Does it matter if it's a single family, 4-family, condo? Like, how does that affect interest rates, Ritchie?
So it affects interest rates because, again, we always relate this back to risk. I believe a single family has always gotten the best interest rate.
Yeah.
But when you go to a duplex, the interest rate gets worse. Remember a couple of years ago, Fannie Mae and Freddie Mac really bumped up the loan level price adjustments for investment properties, right? We're going to talk about occupancy too. But when you look at a person who wants to buy a duplex or a fourplex to live in, it's pretty much assumed that at some point they're going to move out of that thing and it's become an investment property.
Right.
That creates risk in the future.
How long do they have to live in that property when they buy it?
They're supposed to live in it for 12 months. Okay. And avoid occupancy.
2 months or 12?
12. 1, 2.
Do tell me, this is a rhetorical question. I'll just answer. Lenders check that. They send people out. They will knock on the door. They will check on that. So do not tell your borrowers. We have seen people right here in our company that have been issued a demand letter. And a demand letter is like, hey, listen, we know you're not living in that property. You got 30 days to send us the check for it, pay off the mortgage, sell it, whatever, however it is, but we want our money back.
I always say, what happens if there's a fire? And you're not there on month 2 and a tenant caused a fire.
Oh.
The insurance company gets involved, the lender gets involved, and they go, well, why weren't you living there?
Right. I never thought of that.
Yeah.
That's a
So
good idea.
the house type makes a difference because of the perception of what's going to happen. Same with the manufactured home. They've got different interest rates because they have different risk when it comes to storms and a tornado coming through. They're going to probably go through it differently than a house.
Yeah. Right.
So the house type is a factor.
Okay. Fair. So let's just talk about this whole occupancy thing. In the world of mortgage lending, the number one perpetrator of fraud, number one fraud issue in mortgages out of everything, there's a lot of fraud that happens in lending. The number one is occupancy fraud.
Yep.
It is the highest on the radar. Underwriters are trained to look for that first. FBI actually investigates mortgage fraud. So, I mean, it's a big deal. So when you're with a client it's important as a real estate agent that you share that with your clients. Say, listen, it is the number one fraud looked at, is the number one case of fraud is occupancy. So it's a big deal. So let's talk about we're talking about things that affect interest rates right now. Does location affect interest rates?
It does. I mean, I don't have the exact reason on that. I'm just going on the impressions of what I watch because I do loans in multiple states. So I don't really pay that much attention, but it has to, because we get asked what state is the property in, what county is the property in. And so there must be location type difference. Like, would you agree?
No.
Okay.
So I will tell you that by state, there are different surcharges for reasons, but within the state,
Yep.
even though they ask county, because some counties have different rules for what they require in a loan application,
Yeah.
but they will not allow you to change rate if you're lending in Milwaukee versus Delafield. Okay, that is not, that's redlining, that's illegal.
Yep.
But they are allowed to say, wait a minute here, Texas has a higher risk of X, so we build in 25 basis points in our premium there. So we may see a little pricing discrepancy by state, but we never see it by neighborhood.
Got it. So, okay, I haven't paid that close. So I put this in the section of how the borrower can affect their interest rate.
Right.
And I put the location in the US.
Yeah.
But it's really handled then through the loan level pricing adjustments that we talked about
on a state
first.
level.
Yeah.
Yeah.
Okay.
Just so everybody's clear on that. It's on a state level.
It's a state level. So if your borrower is comparing, I had one where they're comparing what state to live in, why is it different?
Yes, that could happen.
Yeah.
So especially if those of you who are like on the border from Illinois to Wisconsin, or even Texas and New Mexico or whatever border you're on.
Yeah.
So you can see a little bit of a variance, especially, there's just Cook County in Illinois, for example, has extra rules that has to happen when someone buys a house in Cook County because it's got such a high level of fraud. The interest rate's not different in Cook County versus DuPage County, but what happens is there's extra rules. But Illinois as a state absorbs that because they can't redline Cook County, they can't discriminate against location, but they can say the state of Illinois as a whole, there's a little bit more of a statistical chance of foreclosure, and usually it comes out of Cook County, to be honest with you. And so they penalize the state as a whole.
So it's kind of like title fees. Those change by states.
Yes, they do.
If I correct me wrong, in Wisconsin, title fees are somewhat regulated.
Yes.
So you don't see this big variances between title companies. Right. But if you go to Illinois,
big variance
in change.
Minnesota, Texas, Florida even. Yeah, Wisconsin's pretty steady on that. Okay, so talking more about interest rates. So customer comes to you and says, Ritchie, I want to lock my loan, and they want to lock it they're closing in 2 weeks. Okay, so that's, let's say 15 days. And another customer says, I want to lock my loan, but I'm not closing for 3 months. Does that affect their interest rate?
It sure does.
Talk to me why.
So when an interest rate is locked, we are holding that interest rate so that it does not go up until the person owns the house. They sign the paperwork to own the house. They got their loan. The interest rate doesn't change if they're doing a fixed rate interest rate. So how long they want that held can make an interest rate higher the longer the time they want it held and reserved. And so we share that. Yes, that's the borrower's decision, but it's also the decision as you're talking about the closing date between accepted offer. I know you have to meet, as real estate, you have to meet the needs of both the buyer and the seller and come to compromise. But I get these ones where it's not going to close for 90 days.
I'll give them a visual.
Yeah.
So this is $60. Let's make sure let's make pretend it's $300,000. Okay.
Yep.
So customer says, hey, I want to lock my loan for 15 days. So that this money comes out of a pool and sets here for 15 days. And it's just debt. Right. It's sitting there for 15 days. Okay. Doesn't cost me that as much money. But now also the customer says, hey, I want you to take that same amount of money and I want you to sit it there for 90 days. So that money's got to sit on the shelf for 90 days collecting dust. Mm-hmm. There's a cost to that. So in conjunction with what Ritchie's saying is the longer the rate lock, that money's just sitting there with their name on it. And now all of a sudden they're like, okay, well, it's going to be 120 days. That also affects because it's been sitting there collecting dust. Now we got to go a little bit longer. So there's a cost to that. So the interest rate is affected, or the customer can pay a premium to lock and keep it the same, but they pay a premium instead. They exchange cash for that, correct?
Right. And that cost, correct me if I'm wrong, that cost, when we talk about it, you're like, well, is that ProVisor's cost? No, there's behind the scenes, there are people, it's a whole world I don't understand called hedging, right?
Yeah.
So at the lenders we place loans at, they make commitments of how much, and we're going to maybe talk about that, but they make commitments of delivering an interest rate. And they got to fulfill those commitments, and they got to fulfill time frames. And when, like James said, it's held, that costs the end lender money, and it gets passed through, and they don't absorb it. And what they got to worry about is what we have an advantage with is, will the person we lock the interest rate? Well, what if interest rates go down? Now lenders are moving people from lender A to lender B, and that lender who locked it and set that money aside in this hedging world just lost money.
Correct.
And there's no way for them to make it up. You guys, as real estate agents, don't know it. The buyers don't know it. We don't feel it as a broker, but that is the reality what happens. And there's people who are experts at that have to manage that. But ultimately, where it gets to affect the borrower or the buyer is, how long do you want the interest rate held?
Yep. Okay. We're live. Ask ProVisor. We're talking about what makes up an interest rate. If you have any questions, please send us an email, james@provisor.com. We'll read. You can be anonymous if you want. We'll read the question and we will go and answer it directly. But right now, we're talking about how interest rates affect the borrower. One of the things is term of the loan, 15, 20, 30. That's kind of an obvious why, but why don't you just speak to it?
The quick why is the longer you want to borrow money, the more expensive the interest rate is, because that's the longer that the lender is exposed with risk of foreclosure. A 10-year loan has usually got a way better interest rate than a 30-year because the risk time frame is way shorter.
Fair. That's fair. So what about income? So like, there's talk about loan programs for people with maybe that are under the median income versus over the median.
You got me with one that's not on the list.
Sorry, guys. I'll speak.
I'm ready for that, though.
Oh, okay.
Yes.
Not part of the script. It's live.
Their income is a factor in the sense of there are loan programs like for people of lower income of, let's just go with 50% or less of the county's median household income. They are trying to serve Fannie Mae, Freddie Mac, and them. They did want to serve that population. Mm-hmm. Okay. And then there's another program where it changes at 80%. Mm-hmm. And then when you're 100%, it's done through the loan level pricing adjustment stuff that we've talked about earlier, but that is their mission, and they give extra benefit until you succeed 100% of the area median income for that county.
Yeah. They're basically people who are financially disadvantaged. They want them to own a house.
They do.
Owning a home changes the dynamic of a family. Just me personally, I remember years ago, my dad came to this country, didn't speak a lick of English, okay? Mm-hmm. And his whole goal is he wanted to buy a home. And he didn't know how it worked and the whole process of all that. My dad didn't make a lot of money, but he still wanted a home. These programs are designed to help people who maybe don't make a lot of money still be able to achieve home ownership, because home ownership is statistically proven to be healthier for the family overall. Yep. I remember we bought that house. It changed our life. I grew up in that house, lived in that house. My dad died in that house. It was, we just want to make, this is a great program. So if you have some borrowers that maybe are financially disadvantaged, you have to make sure that you talk to a loan officer who understands this, because the 50 AMI, the 80 AMI, and the 100, it's complicated. Most loan officers don't understand it. And not all lenders offer the products. We offer them all, but not all do, just for the record.
And we talk about income, but now again, you got to know how the program works. Let's say that median household income is 80% is 90,000 for a county.
Yeah.
And let's say the 100% median income is 100,000. And you got two people wanting to buy a house. One makes 80,000 a year, one makes 70,000 a year. That's 150,000 a year. On the surface, you go like, they can't do this income program. Not true. If they're buying a house that we can qualify them on the one person's income of $80,000, mm-hmm. and we can ignore the other person. We can put that person on the loan, but you can't count their income. These programs only care about the income that's being used to qualify for the loan. So now they can take part in it, even though they make $150,000 a year.
And for all the advanced students out there that are saying, I just had a USDA loan that couldn't do that. Well, USDA is a little bit different.
Yeah,
That's
they
a
are
rural
different.
loan. So they're looking, if grandma lives in your house, they're going to come grandma's social security on you,
Yeah.
all that kind of stuff. But
That's
USDA is a different caveat. We're not talking about that. We're talking about low income home loans.
Yeah, and I'm talking about qualifying income when I gave that, and those two programs are on the conventional only. What James is talking about is compliance income. There's max income limits to do a USDA loan.
Correct.
That's different.
Yeah. Back to, we're talking about interest rates. What
Yep.
makes up an interest rate? Richie, what's next for us on the topic?
Real quick one, fixed versus adjustable.
Okay.
A fixed interest rate is going to be different than adjustable. They're just not going to be the same because you're changing the risk factor again, where that lender, like I have a 2.6% interest rate fixed. That lender's not making a whole lot of money.
No.
Okay. They'll give a lower interest rate to adjustable because they're thinking in the future it's going to go up and they're going to make more money.
That makes sense.
And what I've learned over time though is there hasn't been this appetite for adjustables.
Mm-hmm.
And so sometimes the adjustable can be more than the fixed.
Yeah.
Because of this whole back end that we keep alluding to called mortgage-backed securities and all that kind of stuff.
Fair. What else we got today?
I think that covered pretty much most of it for a borrower. So that section was really to help you as a real estate agent understand the borrower's personal situation had just had all those factors affecting their interest rate.
Got it.
And that's why those rate sheets that lenders like to send out and online banks advertise on the internet just doesn't count for your borrower. Mm-hmm. Like Zillow, they put an interest rate on there, tell people the payment, and they're always shocked. Well, Zillow said that was my payment.
Right.
Well, it's not your scenario on all these things we just talked about.
Yeah. Okay. That's good stuff right there. Okay. So let's go into the market and maybe get a little technical on bonds and mortgage-backed securities and economic news and things of that nature. Okay.
Yep.
So the media's got a big voice in sometimes influencing short-term decisions. So they'll jump on something, hype it all up, and we'll see some reactions. So is there a correlation with the stock market and interest rates? Do you see that at all in your experience?
There is no direct correlation. Okay, that interest rates, because you see something mathematically move this number here, does not make mortgage rates move this number here directly. Mm-hmm. But there is emotion.
Yeah.
I use let's use the stock market, right? Mm-hmm. People aware that they're less aware of bond investing and stuff.
Yep.
But on the stock market, I use this analogy. You own 2,000 shares of XYZ national company that everybody would know their name, let's say, right? And at 2:00 in the afternoon, it's announced the CEO just got fired. Mm-hmm. The stock goes down.
Yep.
Well, why? It doesn't mean they lost money.
Right.
They're just getting rid of an employee.
Yep.
And so that's an emotional reaction to the stock price, irregardless of what their true financials are. And we see that in the mortgage rates, right?
Fair.
That's what the economic news can do when the stock market moves. Or I like to talk about war. Mm-hmm. When people ask me when they want me to predict interest rates, I go, well, here's the thing. If peace happens in the world and all wars were gone, I bet you mortgage rates are going to get better because everything stabilizes.
Fair.
But if everybody gets into World War III, we're probably going to see lower interest rate because that's going to cause economic problems.
Right.
So
economic news does have a subjective role in what happens because, the traders are human still.
Right.
So
they got to manage risk there.
Mm-hmm. So the bond market is kind of a big deal and it's kind of heady, and I don't want to talk too much about it, but I do want you to understand that mortgages there's an instrument called mortgage-backed security, and that's through bonds and the 10-year treasury and all that kind of stuff. That is really what affects interest rates more than the Federal Reserve.
And on that subject, I used the recovery for 2008. Mm-hmm. And COVID as the example, and you can correct me if I'm wrong in understanding this. We saw interest rates drop as we tried to recover from 2008.
Correct.
One of the big influences is these thing called mortgage-backed securities got to be traded to keep our world moving.
Yeah.
If they stop trading, there's really no loans happening, right?
Correct.
Okay.
It affects lending. Yeah.
And if you want more on mortgage-backed securities, just call us for geekiness. But,
Right. Yeah.
but what happened at that time, and when COVID got announced, is the federal government stepped in and said, listen, we can't have the housing industry shut down.
Correct.
That's going to affect all kinds of people. So the government became a mortgage-backed security buyer.
Yes.
They didn't care what they paid.
They were just purchasing them like crazy.
Like crazy, which made the bond market go up, which made interest rates go down,
Yep.
and that emotional effect.
Correct. So once again, the government gets involved and it's had nothing to even do with the Federal Reserve. This was, those who remember this thing called quantitative easing, they kind of deployed that. And when the government says, hey, we're guaranteeing these, we're buying these things like crazy, people are like, oh, this is a good investment. The US government's not going to default on this.
Right.
So I'm going to put my money there. And we started to see rates come back down. Rates come back down. Consumer spending starts to go up. People start to go to Home Depot more. They go to Menards. They go to Lowe's. They buy houses. They refinance their houses. They take cash out of their house to go buy a car, or they pay off other debts. And it was just trying to keep the economy going, but it's artificially keeping the economy going.
Yeah.
And then when the government said, hey, okay, we're done buying this stuff now, what happened to rates?
They went up because they became a seller and didn't care what they sold at.
Correct.
And if we lost money on mortgage-backed, they lost money on mortgage-backed securities, we got to be the taxpayers and cover the difference.
Pretty much. So when Jerome Powell, or the chair of the Federal Reserve, talks, the world does listen, but the mortgage world really doesn't listen that close, to be completely honest with you. So when people are telling you, oh, rates dropped today, it doesn't really affect the mortgage world, because the mortgage world is driven on different factors. What it does affect, those of you who are saying, what happens? Well, home equity line of credits are affected. Business loans are affected. Credit cards are affected. You've got car loans affected. Interbank lending's affected. But mortgages are still derived through this thing called a mortgage-backed security, which is affected by the bond market, which is tied to the Treasury. Okay.
And let's just cover, what does the Federal Reserve really do with that interest rate and what they're controlling? And that is right off of their website. Where did I put it here? The Federal Reserve controls the interest rate that banks borrow from banks overnight to fulfill their reserve requirements of their bank.
Correct.
That's all that rate does. But it has the effect in everything that James just talked about, because let's just go to Business 101. If you own the grocery store and to bring in the food costs more, you don't absorb that.
Right.
You pass it along to the consumer.
Correct.
And that's what happens with the Federal Reserve rate. The banks cost more for them to borrow their overnight lending. They pass it along to the consumer.
So to be clear, the bank borrows the money from a bigger bank, and they don't have all this cash. They have to have a certain ratio of cash compared to what their borrowing ability is. So when they borrow that money, when their cost of lending goes up, then they're sending it to the consumer, passing that through. Just like Rich said, the cost of your groceries goes up, pass that to the consumer. When the banks borrow money from the Federal Reserve, they're passing that cost to the consumer, and that's why it goes up. So that's why interest rates on cars have gone up. That's why interest rates on credit cards and business loans and personal loans and all that kind of stuff goes up because of that reason.
Yeah.
But it doesn't really affect mortgage rates because they're tied to something different.
Tied to something different.
Okay, what else do we have today, Mr. Ritchie?
I just want to kind of sum it up with, when people ask me, I want to give an analogy for your world as a real estate agent, and to understand how difficult this is to answer when they want to know what's the interest rate going to be at a certain time frame in the future, or what's my interest rate, and they don't want to give us all the information we just talked about. And that is, think about for yourselves as a real estate agent, where somebody calls you up and they want to buy a house, and they want to know how much the house is going to be. And the only information you have is that they want a house in Dane County. You're not allowed to ask them how many bedrooms. You're not allowed to ask them how many bathrooms. You're not to ask them what city they want to be in, what neighborhood they want to be in. None of that. They just want to know how much their house is going to cost in Dane County. And we know you can't answer that. You need more detailed information, because all those specs about a house affects the price. And that's our world of mortgage interest rates.
Fair enough. So I'm going to wrap it up with this. We're going to talk about two more things. It is relevant. So if you've got a headache now, I want you to hear what we're going to talk about: hedging, and we're going to talk about forward commitments. best executions and stuff like that. So I'm going to speak to that for a minute and then we'll wrap this up. Okay.
Okay.
If you have any questions, please feel free to email us. We do answer questions live on the air. This is Ask ProVisor. I'm with Ritchie Baumann, one of the smartest loan officers I've ever met in my life. And we've been talking about where do interest rates come from? There's this other thing that's available that in the world of lending that no one really talks about, and a lot of people don't even understand it. So picture this cup right here, okay? This cup gets filled up with coffee, usually, or water, hopefully nothing other than that during the day. Lenders have the ability to say, hey, I want to buy this cup from you in advance, and I'm going to fill it up with loans. So that's called a forward commitment. And the reason they would do that is they say, hey, I think that rates are going to go up. So what I want to do is I'm going to buy a bunch of money in bulk right now. And I'm going to say, we'll just pretend it's 5%. And I'm going to buy this cup and I'm going to fill it up and I'm going to deliver it to you. So now all of a sudden you're thinking rates do go up and your favorite lender's quoting your borrower 6%, but this other lender's quoting your borrower 5%. Like, well, how can that be? And then you call your loan officer, like, why are you at 6 and this guy's at 5? Like, he's lying. There's no way they're doing it, which sometimes is the case.
Sometimes is the case.
But depending on who they work for, if that other lender did what's called a forward commitment, they bought a bunch of stuff that they're going to deliver in the future. They have a certain period of time that they have to fill this up, and all these are going to be filled with loans at 5%, and then they've already got it pre-sold to an investor who's going to take that and package it up and sell it off. So that's called a forward commitment. It does happen. It's not overly popular right now, but that situation happens. And if you run into something like that, just call us and ask. We don't have to do the loan. If you're not sure, we would be deemed, I would deem Ritchie as an expert in this kind of stuff. And myself, I've been doing it over 25 years, so I know a little more than a little. I'd be more than glad just to answer any questions. But if that happens, I can walk you through if it's logical, practical, or it's really a lie.
So, James, that sounds like a good thing for the consumer because they made this commitment and on these lower rates. But what happens if they don't fulfill that commitment?
That's the bad news. So the bad news is that's why it doesn't happen a lot. If I'm the lender and I don't fill this cup, I have a huge penalty. Huge. And we're talking 6-figure penalty, depending on the size of the cup. The bigger the cup, the bigger the penalty. If I don't fill that, I'm in trouble because I made a commitment and I still have to pay them whatever they were going to earn if it was full. So if it's half full, I'm paying like it was full. So I'm getting a huge penalty. So that's why lenders are much more reluctant to do a forward commitment. But some who are really students of the business say, we're going to do small forward commitments just to hedge their risk against something like that. So it is risky. It's back-end lending. Probably thinking, what does this have to do with me as a real estate agent? Just in case a borrower would say, hey, this lender told me this lender told me that. Yeah. And they may not be lying. Usually they are, but there is a possibility that they did a forward commitment on the loans.
Right. They bought too much inventory.
And now they can't sell it.
And they got to discount it.
Right. That's what it is. It's a fire sale. You ever see those furniture stores that say going out of business or too much? They got to liquidate a liquidation sale. They have to liquidate their loan sale because if they don't, they would lose more money to not do it because they've already signed a contract that we're going to deliver you, $50 million in loans. And if I only have 30 million, the buyer's like, well, we're paying 50. Yeah. So you got to pay the difference. So it's messy. So, all right. This is what goes into an interest rate. It's kind of heady today. I like to keep things normally in this show a little bit more basic, but I think it's important to understand that with all the buzz in the media about rates are down, well, guess what? When the Federal Reserve dropped rates, the financial markets reacted accordingly. But now all of a sudden, the rates haven't gone, the Federal Reserve has not raised rates, but mortgage rates have ticked back up again. So that would prove to you that there's not a direct correlation between what the Federal Reserve is doing and what the mortgage industry is actually doing. It's important that you're in alignment with somebody who understands the technical part of this business. Once again, Ritchie, I'd like to say thank you for being on the show today. Thanks for taking time out of your schedule for preparing all this. Thank you for taking time and watching this. If you have any questions, please feel free to reach out to Ritchie or myself. We'll be more than glad to answer them off camera. Once again, have a good day. Thank you.
See you next month.
See you next month.